This is Bloomberg Intelligence.
We're really getting into now the streaming's arms race.
Dish is looking at that and saying we can really build a nice niche for ourselves.
In-depth research and data on 2,000 companies and 130 industries.
The dollar is the dominant currency on the planet.
I think the acquisition is a natural progression of what Microsoft can do with this technology going forward.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
On today's Bloomberg Intelligence show, we dig inside the big business stories impacting Wall Street and the global markets.
Each and every week, we provide in-depth research and data on some of the 2,000 companies and 130 industries our analysts cover worldwide.
Today, we're going to take a look at the expansion of EV charging stations in the U.S. I definitely see more of them in Brooklyn.
Exactly. Plus, mortgage outlook improves as wider spreads stoke demand.
But first, we're going to take a look at the FX markets. You get negative euro headlines are really falling to the wayside here as the long-awaited euro-dollar bullish trigger could unfold. For more on what to expect, we're joined by Bloomberg Intelligence Chief G10 FX strategist Audrey Childe-Freeman. Really, the bullish trigger? Seriously, what does that look like, Audrey?
Well, it has nothing to do with Europe.
Oh, okay. Well, there we go.
So that probably reassures you. But, I kind of feel that at the moment, in particular, it's more of a dollar weakness, potentially a dollar weakness story than it is a euro strength story. And in that respect, I'm referring to a potential turn in the U.S. economy, which is something, that we've been waiting for the past few months. It hasn't happened. And finally, last week, we're starting to get some kind of hint that the U.S. economy may be weakening. And we saw that in particular through the labor market figures, the non-farm payrolls. And you saw quite substantial dollar downside as a result of that. And the euro benefited. But what I would say is that I also kind of feel that, the euro negative narrative that we've been talking about for weeks, and as you mentioned it, it's kind of in the price.
How about from the perspective of Europe in general? Give us a sense of the economy over there, because it just feels like, while the U.S. economy kind of hanging in there, and quite frankly, you could look at whether it's labor or consumer spending and pretty darn strong, but what's the feeling in Europe as it relates to the economy and the current and the euro?
I think the relative growth story is certainly still very favorable to the U.S. and I definitely take that point. But I also feel that some of the very negative narrative that we've had for Europe throughout the summer is probably in the price. And some of the forward leading indicators in Europe, think about the German IFO in particular, that kind of shows that we may be at least hoping for that the bottom may be behind us. And, as you know, FX is always relative. So if you think that this is the case, at the same time you think that the U.S. economy is starting to slow, then suddenly this relative story changes. And it's,
man, that takes away my whole summer vacation plans. But okay, so if that's the call, what is the potential downside for the dollar if it's more based on the U.S. economy slowing down a bit and that run-up slowing down a bit?
Yeah, I think it's definitely, all a matter of the U.S. economy. Where do we go from here? And importantly, it's not just that, because, Bloomberg Economics, and we agree with that, we're expecting, some kind of recessionary forces to eventually feed through onto the U.S. But I think for me, from an FX perspective, what matters is what the Fed says about it. Because if you get the U.S. economy weakening and the Fed still telling you high for long on the rate front, which I think they will for a while, at least for the next, 6 to 12 months, then at what point, that leads the market to become more nervous and worry more about, very hard landing scenario, and that triggers more of a risk-off feel to the market. And actually, you go back to square one. You go back to a stronger dollar because you are in a risk-off context, and that helps the dollar usually. So there are ways to think about this and proxy views to have, which I find quite interesting in the next few months or so. And, one of them would be EuroCAD upside. So if you don't want to go long euro dollar, just because what I've just described, and you're worried about risk sentiment in particular, the Canadian dollar is a very good proxy for the US dollar. And if you see a risk-off move in the markets, the Canadian dollar tends to underperform. So that could be a good way around it.
All right, Audrey, thanks very much. Audrey Childe-Freeman, Bloomberg Intelligence Chief G10 FX Strategist. Thank you so very much.
Let's turn now to power as offshore turbulence proves a challenge for wind turbine makers like Vestas and Goldwind. For more, we're joined by Bloomberg Intelligence Senior Energy Analyst Rob Barnett. You're back in the States. Welcome back.
Thank you so much.
Rob was doing a stint over in London doing some nefarious stuff, I'm sure, but he's back here in the States.
We love Rob.
So talk to us about kind of where we are in the wind turbine business. Where are we in the kind of the evolution of that part of the solar space and the wind space?
Well, it's been a tough few years for the wind industry, to be frank, and we're starting to see some green shoots. Demand really collapsed over the last couple of years, but we're starting to see some sequential recoveries. Well, it's a long lead time business, and it's an expensive and it requires lots of moving pieces to build a wind turbine, especially if you're doing it offshore. So the real big thing in the industry at the moment is we've had some really high-profile cancellations of projects that were going to be built off the coast of New Jersey, and there's potential for others to get canceled as well.
So what I wind up hearing from people in the industry is like, okay, offshore wind is having its own like fumbles and the supply chain issues, et cetera. Okay, all right, fine. But some say that the offshore wind market is not doable. It's just full on too expensive. The platforms where you have to put a wind turbine is too expensive. The pipe and the electrical wire is too expensive. It's never going to work. The other people say, well, we do oil rigs and drill for oil. It's going to be fine. Which is right?
So today, the offshore wind business is expensive. So if you want to put a turbine offshore, it costs something about like $150 a megawatt hour to make the project have a positive NPV. And so that compares with $50 a megawatt hour if you want to do it onshore, $50 for solar. But the thing is, all of energy have these really complex things that occur with it. And so I guess the question right now is the government is subsidizing the industry with the hope that the cost come down over time, like we've seen with other technologies. Nuclear, by the way, very expensive as well. But in instances, the government has decided that they want that technology to exist. And so the same question exists for wind.
What's the difference, or I guess the efficacy or the output, or however you guys measure it, onshore versus offshore?
Well, one of the reasons that offshore is so attractive is because you get higher capacity factors, as it's called. So it's windier out over the ocean or sea. Yep. And so that is one of the appealing components of doing it, is that if you go offshore, you can run at a much higher rate. But it's also much more difficult to build, so that's the trade-off.
Then I guess that brings us to the actual contract part. So usually you're signing like 10 to 20-year contracts, right? And you like lock in a price, let's say 10 years. You lock in a price, so the turbine producer's like, all right, fine, I'm going to get this much if I put this wind turbine right here. Why is that price so hard to come to and agree on and stay with offshore right now?
I think you've got some buyer's remorse. Basically, you had
like New Jersey,
Ørsted come in and agree to a price, and they did it without really understanding what the cost basis for doing the project was going to look like.
Why would they take on all that commodity risk themselves?
Well, if they were doing it right, they would have signed the contract and signed the contracts for the wind turbines and the steel and the ships and everything else you need to do at the same time. But generally, when you're working at a multi-year, I mean, it's 10 plus years to do a offshore wind project often. And so it's not so easy to just sign all of those contracts simultaneously.
All right. You may have read in the papers that I recently purchased a beachfront compound on the Jersey Shore.
He does not want to look at a turbine. I'm just putting words in your mouth.
Yes. So they're going to build a turbine off my beautiful coast? What's going on in Jersey and New York?
I remember when I lived in Boston, every time I'd go to Cape Cod, there'd be people walking up and down the shore with clipboards getting signatures to oppose Cape Wind.
Okay.
And so, yeah, if you have a nice property by the sea, you don't want some kind of industrial...
Are they going to build it?
I think in general, they're really outside of your visual time. You're not going to see it, or it's going to be a little dot on the horizon. But, I hear it. I mean, if you have a nice piece of property, you don't want something obstructing your view. I can appreciate that.
How does wind fit in with solar, nuclear? Is there ideal alternative energy play there?
Sure. I mean, you can ask around. Look, at the end of the day, almost 90% of global capacity additions this past year and probably going forward will be wind and solar, and with a little bit of nuclear maybe mixed in, a little bit of gas. And so the portfolio of the future is increasingly going to have complex, intermittent things. And so if we're going to make it all work, which is obviously important, we're going to need storage. We're going to need to pair up those intermittent things with things that are dispatchable. And so I think there's a lot of basic engineering that's got to be done if we're going to do it correctly and move towards a more emission-free set of energy sources.
I know, I feel like I want to leave it there because it was such like a beautiful way to end. But really good to catch up. Rob Barnett, Bloomberg Intelligence Senior Energy Analyst.
Coming up on the program, we'll talk mortgage resilience.
You are listening to Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries. You can access Bloomberg Intelligence through EVgo on the terminal. I'm Alex Steele.
And I'm Paul Sweeney, and this is Bloomberg.
You're listening to the Bloomberg Intelligence Podcast. Catch us Saturdays at noon Eastern on Bloomberg.com, the iHeartRadio app, and the Bloomberg Business app, or listen on demand wherever you get your podcasts.
All right, with more resilient performance for 15-year mortgage-backed securities versus their 30-year counterparts in October, the carry and convexity advantages have shifted back to the 30-year sector.
Oh, boy.
To explain what this means, we're joined by Bloomberg Intelligence MBS strategist Erica Adelberg. All right, Erica, just refresh our memory here. Mortgage-backed securities, what drives the price of these and the performance of these securities?
Mortgage-backed securities are interesting because they tend to be, the value of them is affected by what the borrowers are doing. So when interest rates fall, the borrowers tend to refinance their mortgages, and the price of your bond doesn't go up as much as the rates that you've been comparing them to.
Right.
So that's a bad thing. And then when interest rates rise, nobody wants to relocate, which is the environment we're in right now. All of a sudden, your price falls even more than whatever instrument you're comparing it to. So that's called negative convexity for mortgage-backed securities. And the more volatile it is, more volatile interest rates are, the riskier mortgage-backed securities become because their prices are going to always behave not quite as well as you'd hoped, whichever way rates go.
So what does convexity mean in this case? Like, so if that happens, do I have to go buy something else to offset it? Like, is that the result?
That's exactly the result. We call it delta hedging in the lingo of investors.
Oh boy. Convexity, delta hedging. This is something,
Nice.
guys.
So delta hedging means that, let's say your bond, your mortgage-backed security shortens a little bit more than the hedge. That tends to happen, as I mentioned, when rates are falling and prices are rising. So you have to buy, even more of that back at a more expensive price, effectively.
All right, so I'm looking at my EVgo function, Bloomberg Index browser. I'm looking at the U.S. MBS, the U.S. Mortgage-Backed Security Index total return, off about 1.95% this year. Talk to us how your market's been trading this year.
It's been a really challenging year for mortgage-backed securities up through the end of October. It wasn't quite as bad as last year, but it's been almost as bad. And the reason is because interest rates have been rising so much.
Yep.
And, not only do you have, therefore prices falling when interest rates rise, but you also have mortgages falling more than their hedges. But on top of that, spreads have also been widening. And the reason spreads have been widening, again, a lot of that has to do with volatility. The more volatility there is, the more people perceive there to be risk in mortgage-backed securities. Now, everything changed. The tone changed dramatically on November 1st when the Fed came out and gave what was perceived by the markets to be an all-clear signal for the moment anyway.
Yep.
And that helped volatility to fall, and mortgage spreads actually recapped a huge amount of their performance on the year. We're even looking at positive returns on the year. Never say never. Whereas if you'd asked me that a week and a half ago, I would have said that we were heading for the fourth consecutive year of negative total returns, excess returns.
I have a really dumb question. If a lot of people go and start issuing mortgages and stuff, or banks start issuing mortgages, what does that do to the market? Like, do I want to be buying MBSs in that time or no?
That's basic supply and demand. So if there's more supply and you don't have an increase in demand, that can be hard for mortgage-backed securities. Interestingly, we're in the exact opposite environment right now. Mortgage supply is at many, many year lows.
Exactly.
It's really hurting the mortgage lending industry. That could be a good thing for mortgage-backed securities, because if you have the same amount of demand for less issuance, then that could be a good thing. The problem is that a lot of the basic long-term investors for mortgage-backed securities are not involved right now. The Fed being, an important contributor, but banks have also not been that involved. And I think, to some degree, if there's an all clear signal and everybody wants to go into equities instead, that could hurt the sector.
Who is a typical MBS buyer? What is the buyer really looking for? What's the strategy?
Well, I'll put out there in the first place, in terms of like mutual fund buyers, there's actually a lot larger buyers of aggregate bond funds. So that's across all sectors. But flows for those sectors do matter as well, because about 27% of the aggregate fund is mortgage-backed securities.
Okay.
Now, mortgage funds are a little bit smaller, but usually those investors are looking for incremental yield and return versus treasuries, because you have a risk premium priced on top of that to make up for that sensitivity to volatility. And then in terms of institutional buyers, the pension funds, the REITs, banks normally, foreign investors, they're all looking for incremental return versus treasuries.
You mentioned two big buyers, the Fed and banks, kind of not in the market as much. I understand the Fed because that's what they're trying to do. But what's up with banks? Is this like a regulation thing that they don't want to be buying them? Or are they just better opportunities? Or what's up with that?
Yeah, I would not say it's better opportunities. A lot of it started with the fact that they had very easy money themselves from the Fed. So they had money to invest. And they had a lot of investors. The deposits also went up during that time. So they had added a lot of mortgage-backed securities, probably above trend in 2020 and 2021. And then as the Fed started letting its assets run off, their reserves also dry up to some degree, and they started letting their mortgage-backed securities run off. Then with the deposit flow concerns earlier this year, mortgage runoff or selling even with SVB, mortgage holdings went down dramatically. And we've now seen deposits stabilize, but we are continuing to see mortgage-backed security holdings at banks decline. And I think most of that's attributable to concerns about increased regulation on what they're holding. They're sitting on a huge amount of losses right now anyway from the mortgages that they do own. So I think, they're worried about increased scrutiny.
All right. If I'm a retail investor, do I get exposure? If I want to get exposure to MBS, are there ETFs for me? Is that the best way? Or
if you want direct exposure, there are ETFs. There are huge mortgage mutual funds.
Okay, but I'm an ETF guy now.
But if you're an ETF guy, there are ETFs. I don't know if I'm allowed to name the names of them. But
there are ETFs. That's typically how a retail investor...
Typically, and in fact, there's a new ETF out today, literally trading today for the first time, that's not just focused on the mortgage index, but it's focused on the mortgage current coupons, which have a lot more spread in yield. They do have more risk, probably because they have more of that negative convexity we started the conversation with, but they definitely have more spread in yield. So a lot of people might gravitate towards that new style of mortgage ETF, which kind of ignores these mortgages that are in the index that were created in such large size in 2020 and 2021 when we were at record low rates. So
do you think that what kind of circumstance do you think the Fed would come in and buy this market again? Because I feel like it could get really crunchy. And what we're seeing is housing prices continuing to stay sticky as well as rates. Like they're not offsetting each other because of the housing crisis in terms of supply that we have. Do you think the Fed at some point is going to have to help solve that on their end?
I think the Fed has expressed, and whether or not they're just jawboning rates higher or not, they've expressed some buyer's remorse in just how many mortgage-backed securities they owned. They had gotten up to, I think, about a third of the size of the mortgage index. So they owned a huge percentage of the mortgage market. And, it's proved rather difficult for them to let that portfolio run off because prepayment speeds, the speed at which people are relocating and paying off those mortgages is so slow at this point. So they're going to have that huge portfolio for a long time. I think, if there's a huge housing crisis, maybe I know like the Mortgage Banker Association is calling for them or somebody else to come in and help buy, to help tighten in spreads to improve mortgage rates for homeowners. The other alternative is possibly there's been some talk, but not much, about allowing the GSEs, Fannie and Freddie, who used to own huge portfolios. In fact, they owned on a percentage basis about as much as the Fed did of mortgage-backed securities, to maybe allow them to increase their holdings. They've been only allowed to hold a small percentage of the mortgage market since the financial crisis.
Right. I remember that. All right, very good. Erica Adelberg, thanks so much for joining us. Erica Adelberg, she is the Bloomberg Intelligence MBS strategist.
All right, coming up on the program, we're going to break down the future of EV charging.
You're listening to Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries. You can access Bloomberg Intelligence via EVgo on the terminal. I'm Paul Sweeney.
And I'm Alex Steele, and this is Bloomberg.
You're listening to the Bloomberg Intelligence Podcast. Catch the program Saturdays at noon Eastern on Bloomberg Radio, the TuneIn app, Bloomberg.com, and the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
We'll be here each and every week at this time, tapping into our Bloomberg Intelligence analysts covering some 2,000 companies in 130 industries worldwide.
As U.S. EV infrastructure providers confront a structural demand and a cost crisis, you got Tesla continuing to cement its place as the industry leader. I'm not totally surprised by that point. Bloomberg Intelligence Senior Associate covering automobiles, Andreas Krohn, joins us now. Andreas, this is just the EV infrastructure stuff. This is not the actual EV. Tesla builds its own?
Yes, they do both. They obviously sell EVs, but they also have been very active from the beginning in building out EV infrastructure. They really have had no choice. They were the only producer of EVs at the time when they started out 10, 12 years ago. So they had to build a reliable and vast network of charging stations to satisfy the buyers of their products.
All right. So where are we now in terms of EV coverage, charging coverage in the U.S. now, and kind of where do we think we're going to get in the next 2 to 3 years?
Yeah, we've built up. We're currently at about 160 ports nationwide. The ramp up is proceeding, but there is, I think, a larger issue. There is a sense, I think, that somebody has let the air out of the EV tire on some level. But we've held a view for some time that EV adoption will take higher much more gradually than initially expected. We've had several announcements by U.S. automakers, GM and Ford, sort of delaying, deferring, pausing on adding EV battery capacity, on adding assembly plants that focus on EVs, and also on stalling or delaying their production targets that truly have been quite ambitious. Those have been thrown out largely by both automakers at this point.
So how much does it cost to build a charger?
So we've done some digging into Pennsylvania specifically. Pennsylvania has been at the forefront. They've been most active out of any state in the U.S. in allocating budget so far to the build-out of charging stations. They have so far 57 projects for which conditional awards have been granted. The average cost of a station is $650,000 US. So quite significant. Typically, that will include 4 ports. It may include canopy. It may include other infrastructure. The cost typically also includes the electrical work that's needed to pipe the electricity into that spot. And Tesla has a significant cost advantage when it comes to building out these charging stations.
All right. Well, I just bought a new car, and it is a gas guzzler. No, it's just a BMW X3, but I'm not going to pay the premium for the electric just yet. I mean, I'm with Kevin Tynan on that one. Right. What's it cost me, if I did get one, what would it cost me to charge up a typical car or truck?
I think at this point it is cheaper to refuel an EV relative to a internal combustion engine for sure, but it does depend on where you do that. Right, there are the affluent areas in this country where the cost may be very comparable to fueling up with gasoline. So the cost advantage to an EV in terms of the refueling aspect may not be all that significant, and it does depend on where you plug in.
How much is how long does it take to get paid back? If I'm like EVgo, which is a pure EV charging network, company, and I'm going to fork over like $650,000 to make one of these things. When do I get paid back for that?
Yeah, it's really years to amortize the cost. We just spoke about the cost per charger, right? You're talking $600,000, $700,000 per station. So you're in the hole immediately upon putting the station in the ground.
But aren't there subsidies at this point to help with that specific problem?
The subsidies, yes. I mean, what these EV charging providers really are banking on is the utilization. The utilization has to go higher to make these investments in infrastructure worthwhile. We're off to a very, very slow start when it comes to the public subsidies. The $7.5 billion under the bipartisan infrastructure law. So far, they've only allocated 12% of last year's funding and just 3% of this year's funding. So we've got a long way to go. Oh, wow. And our view is that the slow rollout is partly due to a complex process that has to be set up to administer these programs, but also I think that tepid demand has a major role in particularly some of the largest states have just not stepped up and even bothered to set up some of these processes.
So, as you guys think about this demand for the EV product, what's the kind of the industry consensus these days? Because as you mentioned, it seems to have become a little bit more tepid here. So is there kind of a revised expectation out there about when or how fast EV adoption will go?
Yeah, I mean, I think the broader industry is coming around to the views that we've held for quite some time. Our view really is that EV powertrain mix may never be more than a niche product. We currently stand at 7.5%. There's a likelihood that we may not get past much more than 15% by the end of the decade, and that actually other powertrains, plug-in hybrids, mild hybrids, may take a much larger share of the mix as the decade progresses.
So how does Tesla try? Obviously, Tesla needs that not to happen. So how is it trying to combat that with its own charging stations?
I mean, they provide the infrastructure, but Tesla has been significantly demand constrained for some time, right? The aggressive price cuts that they've had to resort to for the better part of this year don't come from a position of strength. The only way for them to move the needle and continue to sell at the volume they do is by meaningfully cut the prices of their vehicles, right? They've been cut roughly 25% year over year. So Tesla is really is facing the same demand challenges that the legacy automakers face. The difference, of course, is that legacy automakers can step out of the EV pursuit and focus on what they do best and have done for a long time. Tesla does not have that option.
So, real quick, Andreas, who's going to drive this EV charging path?
It's really, there's two catalysts we alluded to already, but it's EV penetration, number one. And, we feel that the largest states, California, Florida, Texas, where almost half the EV fleet is located, need to play a larger role in this. And then secondly, the subsidies. Yep. Those are the two catalysts for the industry to move forward.
All right. Great stuff. Really appreciate it. Paul's not going to be buying one anytime soon. I'm editorializing on that. Andreas Krohn, he is Bloomberg Intelligence Senior Associate covering automobiles. All right, let's turn now to the $268 billion question. Will banks be able to achieve net zero? To answer that, let's welcome Bloomberg Intelligence Director of U.S. ESG Research, Eric Kane. Before we answer that, let's define what banks achieving net zero for them actually means.
Sure, it's a good question, and it's one that has a lot of interesting data points surrounding it and perhaps even lack of data points. So what net zero really means for banks is achieving net zero from financed emissions. So basically stopping lending to industries, companies that are emitting CO2.
All right. U.S. banks versus non-U.S. banks. Where are we on our commitment to net zero?
It's a good question, and I would say since the development of the Net Zero Banking Alliance, which is part of GFANZ, or the Glasgow Financial Alliance for Net Zero, we've seen about 40 or so banks globally sign up for this commitment, and it is pretty equally spread across regions.
Do I run the risk if I'm JP Morgan, for example, and I sign on to this, I can't do a municipal bond for the state of Texas?
Yeah, and Texas isn't going to like you at all, which
Right.
has happened.
Yeah. That has certainly happened. So I think this is one of the details that definitely needs to be kind of ironed out. When we look at what the banks are committing to right now, it's less about bond underwriting and more about their direct lending. So I don't necessarily see that they're going to stop underwriting any bond that may have some, downstream association with, CO2, for example.
Okay, so then if we go the other way, if they do just sort of cold turkey or slow down on direct lending, is that going to make a dent for them in terms of getting to net zero?
It's a great question, and that's one of the funny things is we actually don't really see it having a big dent for them, because if we look at a bank like HSBC, for example, based on the data that we have available on Bloomberg through League, we see lending to the industries that I mentioned before, again, oil and gas, power generation, cement and steel, and coal being about 3% of HSBC's loan book. So it's our view really that if they were to stop that even overnight, it would have a pretty minimal impact on their lending business.
All right, so where are the big U.S. banks, Bank of America, JP Morgan, where are the big U.S. banks on this?
Yeah, I would say they're kind of spread across the spectrum. We see a bank like Citi leading. Citi has set really pretty aggressive targets to stop or to limit financing by 2030 that, in our view, is very much in line with the IEA guidance in terms of what's needed to keep us on a 1.5-degree trajectory, if that's even possible. Other banks like JP Morgan, Wells Fargo, for example, are trailing. They have not set as comprehensive targets or targets that are really aligned with that scientific guidance.
Do shareholders care about this?
It's a good question. I think they do. And what we're also seeing, we've seen some shareholder resolutions in the last couple of years related specifically to finance emissions and increased disclosure on finance emissions. But I'd say the other group that's really starting to care is regulators. So in Europe and in the U.S., we've seen regulatory bodies starting to do climate stress testing for the major banks and starting to put rules in place in terms of how banks should ultimately be measuring and managing the transition risk, both in terms of what they're lending to, but also potential physical risk and how that can impact other aspects of their business.
Is there concern here that it just feels like the ESG movement has significantly lost momentum in the States over the past 2 years? While I understand from your colleagues in London, Tim Craighead, that it's still a very big investment theme for European companies, European investors. It feels like it's become politicized here in the U.S. Is that potentially a roadblock for the banks and then just, I guess, ESG stuff in general?
It's a good question. I would say the ESG pushback has certainly created a lot of noise when we actually look at specific numbers, whether you're looking at green debt issuance or flows into ESG-related funds. There has been a little bit of a downturn, certainly here in the U.S., less so in Europe. But I think when you look at those numbers, the noise that we're hearing is perhaps a little bit overblown, and it's not really having the impact that you might expect. We do, of course, see certain states setting rules to stop engaging with certain banks that they view as being too, ESG friendly, for example. So that's a potential impact. But in terms of the overall market, perhaps a little bit of a downturn this year, but not one that we ultimately see having a long-term impact.
All right, Eric, thanks a lot. We really appreciate it. Eric Kane, Bloomberg Intelligence Director of U.S. ESG Research.
That's this week's edition of Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries.
And remember, you can access Bloomberg Intelligence through BIGO on the terminal. I'm Alex Steele.
And I'm Paul Sweeney. Stay with us. Today's top stories and global business headlines are coming up right now.